Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, John Briggs and Giles Gale.
Okay, Imogen, we're going to start with you because I think that any discussion of markets has to start with the UK this week. And now maybe we should just leave it as a sort of fairly free form. What has been going on and start anywhere, I suppose.
Where to even begin? So much has happened since we caught up on Bondcast that maybe we should just do a bit of a recap to work out how we ended up here. But essentially, we had the Bank of England last week who raised rates by 50 basis points, as was expected. But they were taken slightly hawkishly by the market in that they, at the time, announced that they would be going ahead with bond sales, QT, active sales of their gilt portfolio, as they'd planned to in the August meeting. And now that was taken a little bit hawkishly at the time because it was felt like in the face of all of this fiscal issuance that the market expected to come on board, the Bank of England also selling bonds back into that environment was perhaps adding unnecessary bearish pressures onto the gilt curve. So there was some discussion, particularly given some comments that have been made earlier on in the week by Hugh Pill at the Treasury Select Committee. There was some discussion that they might delay or even slow the pace of active sales, but they didn't do any of those things last Thursday. So that was kind of the first hawkish kicker, if you like, that sent yields slightly higher on Thursday afternoon. We then had the mini budget on Friday, which, although a lot of the measures were as expected, some of the tax cuts were larger and broader, let's say, than had previously been trailed in the press. So overall, the borrowing that the mini budget was projecting for the years ahead was greater than the market expected. And that's what really kind of kickstarted this major sell-off that we've seen in the last couple of days in the gilt market. Kwasi Kwarteng, the new UK Chancellor, then sort of doubled down on this easing rhetoric in terms of more tax cuts to come, more fiscal stimulus to come over the weekend. And we opened on Monday morning quite significantly weaker in gilt yields, pretty broad-based weakness. And there was also weakness in the currency as well. And that's what was the big kicker, I suppose, for the market beginning to think about intermeeting hikes from the Bank of England or intermeeting interventions. There's been a lot of volatility since then in terms of, are we going to see intermeeting rate hikes or not? The Bank of England did come out on Monday afternoon and said that they would reassess everything in their new updated forecast round, which will be in November. Hugh Pill was pretty adamant that they would plough ahead with QT, but obviously, as we now know, and if you don't know this, I'm surprised you're even listening to this podcast because you probably have no interest in anything that I've just said. But the Bank of England have now, as we know, rolled back, well, not just rolled back on QT in terms of pushing that start date back to the end of October, but have actually restarted a form of QE, although obviously it's QE by another name, as we know central banks now prefer, like the ECB with the TPI. And that was largely related to, instability or dysfunction, if you like, that we were seeing in long end yields, and the implications that has for a certain sector of the UK market, the LDI community and the pension fund community, and the implications that, significantly higher gilt yields have on their funding ratios and their solvency. So that's where we've got to today. We've had one of these auctions, the long end that the Bank of England have conducted. It was quite small. They're able to do 5 billion a day. They only did 1 billion. They're doing an auction now as we speak. So by the time listeners listen to this, we'll have a bit more information on how that has gone. But overall, there's been many moving parts, and I kind of just scratched the surface in everything that I've just said, but I'm not sure that our outlook for markets is really materially altered versus where we were just 1 week ago.
amongst other things, just put out a note on what you think about this whole situation, ranging from the Bank of England outlook through sterling to gilt yields. And so I just wanted to draw you out on a few of the main points there. Perhaps just starting with where the market is and where you think the Bank of England is likely to be heading.
Yeah, I guess that's probably the biggest change in our view, which is what I was just about to say, is that the market, like I say, I mean, front ends have been very, very volatile. At some point on Monday morning, we had 75 basis points of inter-meeting hikes being priced in. We've settled a lot lower than that now. There's still, some likelihood of an inter-meeting hike being priced into markets, which we don't think is correct, and we'd push back against that. But we've revised up our bank rate call, largely after relatively hawkish rhetoric, I would say, from Hugh Pill earlier this week, that this significant fiscal easing is going to require significant reaction on the monetary policy side. So we now
his
expect
repetition, not yours, right?
His repetition, I should be clear. Yes, I can think of other words, but very much his repetition. So we now expect 100 basis point hike in November, an additional 100 basis points in December, and 50 in February. So that takes our terminal rates about 4.5%. That's quite a lot below where the market is pricing. The market has about 150 fully priced almost for November, and has terminal rate closer to 6%. At some point this week it's been higher than 6%, but we're a bit lower than that right now. So I would say that's where we probably see the biggest gap between what we think and where markets are most mispriced, I would say, is in terms of bank rate pricing.
Okay, so indeed, I suppose that one of the main points that you've been making is that the market seem to believe that the Bank of England is going to be exceptionally aggressive, mainly to defend the currency, whereas you don't see that because the pain that would be involved in order to defend the currency at a certain level is just infeasibly large, right?
Well, yeah, infeasibly large, and although clearly the currency has a huge influence on inflation, the Bank of England is an inflation targeting central bank, not a currency level targeting central bank. It's very different them intervening to protect the functionality of a certain sector of the bond market, which they have the firepower to do, versus beginning this game of trying to defend the currency. And the rate hikes or the monetary policy tightening that would probably be required in order to defend the currency at these levels would be almost impossible for them to deliver, given the impact that it would have elsewhere on the economy.
And you've also updated your profile for gilt yields.
Yes, we have. I think the main story for gilt yields is, it goes back to what I was saying at the beginning of this podcast, is that actually, I don't think the Bank of England's intervention in the bond market materially alters the medium-term outlook for gilts. It doesn't materially change the net supply outlook, which is really what's been driving rates higher. That's at the root of this move, is that there's going to be a huge amount of additional supply for the market to take down, and it's not obvious who the buyer of that supply is going to be. Listeners of this podcast are probably bored of hearing me say that, but ultimately that's what's been driving the sell-off, and that hasn't changed. The Bank of England, in its current guise, the intervention is that they can buy 5 billion of 20-year plus bonds for the next 13 working days. So that's a maximum of 65 billion. Now, they only bought 1 billion yesterday, so it's actually just about 60 billion now from here, but let's just call it 65 for calculation's sake. The total rundown in the stock of the gilt portfolio that is planned when they begin QT over the next 12 months is 80 billion. So even if they bought 65 billion gilts over the next 2 weeks, the Bank of England aren't even fully offsetting the impact of QT, assuming that goes ahead as planned. So from a net supply perspective, in terms of what duration is going to be left for other investors to take down. The Bank of England doing a small amount of QE over the next couple of weeks doesn't really change the fact that, there isn't going to be a U-turn from the government in terms of its major spending plans. We don't think a huge amount of gilt issuance is still going to hit the market over the next couple of years, and that gilt issuance has to find a home in a high inflation, low growth world where there's globally a lack of demand for duration, but certainly a lack of demand for UK assets. So to put some numbers on that, just quickly before we wrap up, because I think I've probably been monologuing for long enough about the UK, but to put some numbers on that, I think that means that, the move that we saw in gilt yields so far hasn't been particularly divorced from reality. I think it was just the speed at which it happened, which was perhaps more concerning. But I still think that gilt yields over the 10-year yields over the medium term are likely to settle closer to 5% than 4%. And that's what we've upgraded our target to on 10-year yields is 5%.
So maybe just one final question, Imogen. One of the points you already mentioned, that you don't expect a U-turn on any of the budget announcements that seem to have been the sort of proximate trigger for all of this. That's one of the questions which has come up again and again, and it seems like there's a lot of hysteria and excitement about on a number of issues, and it doesn't help when the headlines in the press, the IMF getting involved. It seems like there is an awful lot of noise, but in addition to everything else, it seems like there are some people who have been genuinely concerned about the possibility that this might be leading to something more lasting and systemic. Perhaps a key and difficult question, but what's your view on that?
Well, I guess just to answer the first part of that, I think you're right that there's an awful lot of noise about essentially what the headline is around unfunded tax cuts. But actually, when you look at the increase in borrowing over the next couple of years, the bulk of that is due to this energy price cap. 60 billion of the 70 odd billion of increase in gilts that has been announced for this year is all related to the cost of capping energy prices at 2,500. So although there have been, some unfunded tax cuts have been announced, they're only a very small proportion of the borrowing that the government intends to do. And therefore, the prospect of those being unwound, I think, is anyway very unlikely. But the impact of those being unwound is very minimal, given that, this government or any other government had to do something to mitigate the impact of rising energy prices on the consumer. And perhaps you might argue that it could have been maybe slightly smaller. It could have been maybe a little bit more targeted than what was actually announced. But ultimately, any government would have had to have announced some broad-based and fairly costly program to mitigate this cost of living crisis. I think that we'll find out more at the end of November, and that could be a key date, I suppose, in terms of restoring market confidence, if you like, in the current government, because one of the problems with the mini budget that we had last week was that it was delivered without any updated projections, both in terms of fiscal plans, but also in terms of the growth and inflation projections of the OBR. So perhaps the government will use the 23rd of November, which is the date that we will get updated projections, to provide some kind of multi-year assurances about the trajectory of public finances essentially in the UK. But overall, I think probably the concerns about, risks of snowballing debt and debt sustainability at the moment are probably a little bit overdone. So with that, let's, not stray too far away from the UK, because I think it's been the influence of all markets this week, but perhaps I'll leave it up to you to talk now, Giles. So are there any implications, I suppose, from what we've seen in UK markets this week for euro area rates?
Okay, I mean, the answer is yes. There clearly there has been contagion. There's been some, I would say, sort of trading technical contagion, but there's also thematic contagion as well. So, there's interest, of course, in whether the kind of dynamic that we're seeing due to, what appears ostensibly to be a market reaction about to an extent, the feasibility of a certain fiscal position in a higher inflation environment. And you don't have to look all that closely at the fiscal positions in Europe to see that also applies in a smaller way, but it applies across the euro area. So yes, I would say that's in the mix. Clearly with differences across countries, which I don't think we'll get into today, perhaps in the Italian context. But anyway, the other things, there's obviously interest in whether we might see some kind of the sort of the dynamic which is self-fulfilling that we've seen in the leveraged investments, the LDI community in the UK, whether that might be, there's a possibility that the setup is sufficiently similar in Europe that might develop. My reaction to that is probably not. The UK is particularly concentrated, particularly sort of dominated by players which all sort of mimic similar kinds of strategies, and so that doesn't really apply in the European context, which is a lot more diversified. But it is imaginable, and so perhaps that's something that we need to come back to. There is a resurgence in all manner of other kinds of technical factors in markets, just because we're coming, because of what we've seen in the UK, but also because we're coming up to the end of the year, because liquidity is poor, because people are trying to lock down risk and thinking about, okay, so what happens with things like what happens with the VAR shock? What happens with legacy sort of structured product positioning? What happens with things like trend following accounts and the way that they may have been drawn into certain positions, for example, curve flatness, for example. Are we potentially, do we need to think about the possibility of an unruly unwind of any of these things? So it's very much on the radar, but the markets have not been moving anything like what's been happening in the UK, and we've all just been strapping ourselves to our seats, to be honest, for the ride to a certain extent.
But they have been moving a little bit, and I guess a lot of that is contagion from the UK. But as Matt said, Giles, bund yields did reach your long-held 2% target, 10-year bund yields, that is. How are you thinking about that target now? Is this, are they rallying back down through this, or is it going to 3%, 4%?
Yeah, the spread widening in Italy is pretty much in line with the widening that we've seen in other risk assets. So it's not really, I don't think, driven by any anxieties about the Italian election outcome. In actual fact, the election was pretty much in line with expectations going into the expectations that have been formed over weeks, at least, into the election itself. And actually, whilst before the election there was there were some slightly more concerning outcomes that seemed possible. For example, the possibility that the League and the Brothers of Italy alone could have commanded a majority in both houses, or indeed that the right coalition might have had a supermajority that would have allowed them to tinker with the constitution. So those didn't happen. And broadly speaking, I think we are now moving into a period of relative calm in Italy, where when a government won't be formed straight away. That's a process which will take weeks at least. And so it'll probably seem relatively quiet for the time being. And as we've said again and again, there's no sort of sense of crisis about any of this. It seems like the new government's intentions are broadly what the market wants to hear. Of course, some investors may see a future where if they're put in under pressure by economic developments, they may revert to whatever they believe their type is. But at the moment, they're saying the right sorts of things, and the budget funding position all looks okay. The whole energy issue also looks okay. It doesn't look like we are facing an imminent crisis here. So broadly speaking, I think that we are at levels in Italy where we probably should be expecting the ECB to be providing support. So that's not far below 5% in 10-year BTPs and 250 basis points in spread. But of course, I don't know whether that's taking place or not. But I certainly, at this point, would expect the ECB to lean into any additional pressure. So I don't see a particularly attractive risk reward in being short Italy at this point.
Okay, that makes sense. Thank you, Giles. So moving over to the US then, John, how has what has happened in the UK this week impacted US markets?
Yeah, I mean, similar to Europe, we're certainly the tail of the dog here for once in the US. And I just think it's striking showing just how much markets are moving when you ask Giles by hundreds of basis points if his target's going to be moved. We're not talking about 25, we're talking about full percentage changes as potential
Giles
targets.
quipped earlier this week that 50 basis points is the new 10.
Yeah, exactly. And, kudos to you for having, that first 4.5% and now 5% to your gilt target, which you've had. So in the US, though, a little bit different. I would say, obviously we're being whipped around by some of these moves, different parts of the curve moving at different speed. You're never not going to have that spillover effect. Giles brought up something, which is a question of how many of these issues facing, UK LDI and other accounts could be possible risks in the US. But I think that part of the answer to that when it comes to the US is that, our rate move, at least to more recent times, was kind of fairly well signaled to some degree. So investors did have, even if it's a small amount of time, did have some time to prepare for some of these moves. Whereas I think in the UK, it was such a sharp, short-term, unexpected market reaction that there wasn't a lot of time. So we're less worried about that there. But more broadly, we had 10-year yields moving up to 4%. Just for context, we have them ending the year at 360. So, but the problem with these times like this is even if, you're at 370, 380, 390, 4%, when you've got gilts moving 100 basis points a day, it's not really realistic to say, oh, well, you should be buying 10-year scaling in at 4% because we see them 360. So, we do think that is kind of the medium-term guide stone out the curve, and we remain there, but we're highly cognizant of the realities of the market, and that investors are going to need to see the dust settle here before finding closer valuations. Now, of course, just today we're back down around 380. We were 370 this morning. So, the market volatility is enough that it's kind of within the range of nearby. Even 4% is pretty close to 360, given that's like a 2-day movement. More on the front end, though, we actually think things are pretty fair there also. Now, the market's got pricing for 4.5 terminal Fed funds. We think it's closer to 5%, but we think the differences are that we have a couple extra hikes back into 23. And the feeling is the market doesn't necessarily need to price all of that right now, right away. So we could see a situation where if markets settle down in these areas, 2's at 4.25, that you start to see more of a drift rather than, a revolution in the markets that we've seen that takes this pricing out. And, it'll take a few CPIs and things like that to get the market to price in that additional thing. But we do feel very confident in the end that, the front end is going to drift a little bit higher over time. Because even today, for example, Bullard looked at claims being under 200,000 for the week and just is reminding us that the labor market still is very strong. And in the end, until they see some loosening in the labor market, until they see, have more confidence that we're not seeing second round effects for obviously important everywhere, but those wages aren't going to feed through inflation expectations, et cetera, they're going to stay on the ball. So I don't see anything happening overseas impacting the Fed. What's going on in sterling is not going to have a big impact on our inflationary outlook. If it dollar EM, dollar China, that has much greater impact. But even there, our inflation is mostly service driven, not good inflation. It's goods inflation. So, I think the Fed's pretty much on track. So what we're talking to clients about is, all right, just survive volatility, take a deep breath. Yes, we think yields will probably settle in around these areas, but recognizing that just putting out a blanket, hey, buy at 10, it's at 4 because they're going to 360 right now. It's just more of a let's be cautious, save that capital time of year.
Yeah, that definitely makes a lot of sense. Here's hoping to quieter markets then over the next couple of weeks, and we can add some more value in our views. All right, thank you both very much for joining me this week. I'll let you get back to the desk because there is a lot going on, but we will catch up again next week. And like I say, hopefully there's a little bit less to talk about when we do catch up next week. Thanks, see you next week. And just a reminder to our listeners, if you liked today's episode, don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thank you.